Hello and welcome back to All Things Money. I'm your host, David Blain. And during this segment, we're going to continue a little discussion about supply and demand. In the previous segment, I talked about in the economy in general, prices are set based on the supply and demand curve. This goes for a completely open and free exchange of goods and services, as well as ones where there is government involvement, be subsidies or price controls. It comes down to supply and demand. The same is true in the stock and bond market. We saw recently, starting last year, a huge weakness in the municipal bond market. Municipal bonds are bonds issued by local and state governments for funding roads and hospitals and state government operations. I just had a new client that came to me yesterday. I saw their portfolio. They had some Onslow County hospital bonds. And I just started laughing because I know how supply and demand works. And when the Onslow County issued those bonds, they went to a broker force, probably Edward Jones, or they do a lot of municipal bond placement. And they said, hey, we need you to, nothing against Edward Jones, but that's a lot of what they do. And they went to their customers and said, oh, we need to, we think this Onslow County hospital bond would be good for you. And they sold them, $5,000 worth of the bonds. That was their, Edward Jones agreed to sell it for Onslow County, and they earned a fee for that. And the brokers at Edward Jones, they try to put it into their clients' accounts. And they sell it at whatever price was set with the bond offering. And let's say they sell them $5,000 worth of an Onslow County hospital bond. If you go to sell that bond, there is virtually no demand for that whatsoever. And so you may look on your statement and let's say that the interest rate is around say 4% and it matures in 10 years. So it's going to be trading roughly, say, around par, say $99. Most bonds trade at a par value of $100. So let's say it's at a slight discount, $99 is printed on your statement. What most brokerage firms do for pricing on bonds is what they call tranches, is that they look at similar quality credit rated bonds of similar maturities, and they price them, not pricing, matrix pricing. They use matrix pricing, and they make these big matrices of credit quality versus maturity, and they come up with a price. And they say, okay, well, this bond should sell about $99. I can tell you now, if you go to sell that bond, you call up your brokerage firm and you say, hey, I'd like to sell my $5,000 worth of Onslow County bonds. They, unlike a stock market, you can't just click a button and sell it. They have to put it out for bid, and they'll put it out on the street. Goldman Sachs, Merrill Lynch, whoever wants to bid on this thing. They get the bids in, and you're probably going to get bids. You could get bids in the 80s on that, and you think it's worth $99 because there's just no demand for a lot of these smaller municipal areas, especially North Carolina. Places like California, New York have higher demand for municipal tax-free bonds, but there's just no demand, and so the pricing is just terrible. The same thing happens in the stock market when you look at supply and demand, and so determine, to get an overall feel for where the market is going, we like to look at what's happening in supply and demand. And so looking at the trend of supply and demand, and so one of the things that effective way to do it, if you want to get the trend of supply and demand on the S&P 500, is you would take all the issues traded in the S&P 500 and ones that went up in price that day, you would say there was more demand than supply. That's why the price went up. If the price goes down, that means there was more supply, more people wanting to sell than people wanted to buy. And so if you take the dollar volume of all the companies that went up in value and all the companies that went down in value, you can get a relative direction of supply. So for example, if today, there was $1 trillion of money spent on companies going up in value and 500 million or 500 billion spent on companies going down in value, well, the volume, dollar volume of money being put in companies going up is much higher than the volume of money being being paid for companies going down. So you would say there that the demand has the upper hand, that there's more demand than for stocks than sales of stocks. And so you can get a feeling for it. So for example, at the lows in 2008, you had this supply curve way up here. In fact, my arm is probably off the TV screen. And you had the demand way down here, once again below the TV screen, that the supply and demand were nowhere near each other. As 2008 progressed into 2009, you saw demand starting to creep back up, and you saw supply starting to intersect, to where today we have the demand is higher than the supply. And these are things that we look at. At every low point, when the market starts to go down, you will see these supply and demand curves cross when the supply starts to outpace the demand. It just gives you a good feeling for what's going on in the market. And so if we look at back in early 2010, somewhere around April, we had a crossing, mix there for a while. The market was going down and trying to decide what to do. Then we had a rally in through the end of 2010, especially in the U.S. market. We had, starting in February, the supply really went up and the demand started falling. And so we see that we have a narrowing once again of the supply and the demand curve. That's the point of, half of the last segment and this whole segment is to let you know that we're currently in a narrowing of this supply and demand curve, that the demand for stocks is falling and the supply is increasing. More and more people, dollar volume wanting to sell. And as these two converge, if they cross and your demand once again drops below the supply, the aggregate level of pricing in the market drops. This is a great thing to pay attention to, especially in the intermediate term time frame. If you've got some extra cash coming in, you may think, hey, Coca-Cola is worth $40 a share and it's trading at $30, but on an interim basis you may want to see if you can get it for a better price. Once again, over the long term, prices should reflect the fundamental values, but over the short term, think supply and demand. Well, believe it or not, that's all the time we have for today's show. I hope you've enjoyed it and that you will join us again next week. So for All Things Money, I'm David Blain, and we'll see you next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.